Good afternoon, everybody. I'd like to welcome all of you to the 13th Annual Florida Insurance Trust Educational Retreat. It's hard to believe that it's been 13 years already, and we had to all count on our fingers this morning to make sure that that was the correct number. So we had triple check, so we're sure that that's the one, even with the one we missed as of a result of Hurricane Matthew. So I wanted to, before we start, recognize a few people. First of all, my team, NPIS, we have grown a lot over the years. We started off with like 3 of us, and now we're up to 20, as you can see. I'm pretty sure it's 20. No, it looks like 24, actually. I can't count today. So you'll see us. We are the sea of yellow shirts here. We're everywhere. So we are here to serve you. If you have any questions or concerns or just suggestions about next year, there's also a suggestion box that was right outside. We're going to have a wrap-up session tomorrow, the last one, to talk about things you'd like to see in the future, or maybe a different venue, although we are changing venues next year to the Dolphin, and we'll be there for 2 years as it stands right now. We're very excited about that as well. So if you have any questions or anything, see one of us, and we hopefully will be able to get you the answer, but I'm sure we will. Might not be right that second, obviously. So we'd like to give a little bit of information about FIT before Shane gets into his presentation and I introduce Joe. Obviously, we started 13 years ago, like I said, and we've grown from just a few members. And I wanted to recognize the 3 originally founding members who are members of our board, and that would be Joe Anello and Jim Weeks and John Cherry, who had to step out for a while, but we'll be back a little bit later. And these 3 folks had the foresight when Shane came calling that first day way back in 2007 to take a chance on Florida Insurance Trust, and saw that it was a great idea, something brand new to the nonprofit and social service market. Obviously, pooling was not a common concept back then. So obviously they've had the foresight to do that, and they give their time without reimbursement of any kind to make sure that the trust runs perfectly, and they give their great business advice, and we are very happy to have them on our board, and we're very thankful. So with that, I am going to introduce Joe so he could speak a few words. Obviously, Joe Anello is the president of United Community Options of South Florida. He's been there for over 40 years, but he's not that old, really. So thank you all.
So yeah, my job is to welcome everyone and thank you for coming. I'd like to recognize just a few people. Obviously, I want to thank everybody here and all our members of the Florida Insurance Trust. As Peter said, we've grown dramatically in the 12 years, probably by 20-fold. And it's a testament to all of you in this room who believe in us. And hopefully, I know you're all good business people, that you're getting your money's worth and your value out of us. Also like to thank all of our brokers that are here today and the ones that couldn't make it. They play a vital part in the Florida Insurance Trust by keeping it alive and well and in the forefront of people's minds as they go around to their clients. And most of all, I'd like to thank NPIS, Shane and his group, Peter, Noel, everybody at NPIS. They are the management arm of the Florida Insurance Trust, and they do just a fabulous job. I mean, we couldn't have picked a better group to manage all of our affairs and to keep us in line, and as makes the job of the Board of Trustees, very, very easy, because these guys are so good and so professional. So we thank you guys, Shane and all your people, Hasib, and they're nice people on top of it. Go figure. Yeah, most of them. Yeah, most of you guys are. And as Peter said, we're in our 13th year of our educational conference, and the idea of the conference is hopefully to provide you with some pertinent information that you can go back and use. That's why we always need information and feedback from you on what you'd like to hear and like to have presented information on for the next year. So please make us aware of the topics that you want us to provide information on, and we'd be more than happy to do that. Also, we use this opportunity every year is to bring you up to date as members of the Florida Insurance Trust on the health of the organization, what it looks like, what our financial positions are, and Shane will do that in a minute, because I think it's really important that you can see and have confidence in the numbers behind the products that you're buying. And lastly, the last purpose of our educational conference each year is just to provide an opportunity for socialization for members of the trust and prospective members of the trust, just to get to know each other personally, share ideas, and that's what's really the goal of many, many conferences anyway, not just the content of the conference, but also the opportunity to pick up tips and just talk and commiserate in some cases with other members that like you. So having said that, Peter, I'll turn it back over to you.
Thank you, Joe. I am going to let Hasib introduce Shane.
Good afternoon. So our next session, of course, as Joe alluded to, is of course Shane Caldwell, CEO of Ballator Insurance Group. And this is going to be the primary session where we go through the nuts and bolts of fit, the financials, and that sort of thing. And yeah, I think we've got a lot to discuss. So with that said, Shane Caldwell.
Thank you. Now my voice is big. I don't really need this, so I have to kind of figure up where it is so I don't get too loud. But echoing what everybody said before, we really appreciate everybody coming. We understand everybody's got tight constraints on their time, so for everybody to take a couple days to come hang out with us, it's greatly appreciated. Peter showed a picture of his team up here. Obviously, to make this thing go, it takes a lot of people. That's just the NPIS team. In addition to that, we have several sponsors. Some of them have some representative here. They don't. Some of them don't. But I think everybody knows we've got a dedicated claims team down at York. We have wholesale brokers, Amwins that we work with. So, I mean, literally there's a host. The agents, several of the agents are here. Some of them couldn't be here. But we really appreciate their support. That's really one of the front parts that makes this thing go. And also the associations. I mean, we work closely with the associations. During the past 10 years, I don't know the exact number, it may be in the presentation, we've probably given back $250,000 to them to support various things that they do, and also various organizations. We try and be very active in the community and in the with the organizations. And now what I wanted to do was just kind of give you a brief overview of what we see going on in the insurance market. We pride ourselves on keeping the members apprised. If something really negative happens, we're going to be the first ones to come out and say, this major hurricane, there's going to be major price increases next year. Whatever the issue would be, we'll be very proactive about it. And we always come out like 60 days ahead of time, as everybody knows, with indications so everybody can handle it in their budget. And then by 30 days in advance of your renewals, that's our commitment, is to have hard renewals so that you guys can make the pertinent business decisions that you need to. So the first thing, I mean, we live in Florida. Probably every year when we talk, property insurance is the #1 topic. Every once in a while, there'll be a big rate increase in comp. But for the most part, we talk about property. You know, we had our big hurricane seasons back in 04, 05, and 06. And then we went through a long string period of time where we just got lucky. Flat out, a lot of people don't realize that the number of hurricanes every year is very consistent. It just happens to be if they hit somewhere in the U.S. The other thing I don't think a lot of people realize is, I'm pretty sure we got some numbers in here. All of this property market, there's only X number of worldwide carriers, so really all the capacity in the world rolls up. So we've had good years in the past in the United States, but if a super typhoon hits over in Taiwan, it's the exact same carriers. So really we look at total worldwide dollars of property losses, and essentially the magic number is $100 billion. There's enough money set aside to cover about $100 billion a year without getting into the property carrier's surplus into their pocket. So, I mean, that sounds like a big number, but if you look at it, that number's been consistently going up to where it's almost always over 100 billion at this point. And what's happened over the past, since the end of 16, obviously, we had storms come in 17, so if you can see the rate trends, we had several years in a row where we actually were looking at rate decreases overall. Obviously, there's a variance between where you're located, your construction, all that stuff, but I mean, if you just look at the whole industry, if you go back to 16, all the way till September of 17, we were in the negative territory. Well, what happened? We had a big hurricane, and it pushed it positive. And so since about the end of 17, and this would actually continue on, we've seen rate increases quarter over quarter of about 2 to 2.5%, and it keeps going up. And with the experience that's happened this year, we don't expect that to change. Now, one of the nice things about FIT is we're not immune to this. I mean, we'll talk about the reinsurance and insurance we buy. We buy an awful lot of insurance. We're certainly not immune. We're getting ready for a tough renewal ourselves because property insurance is going to go up a fair amount. What we do for you is we level things out so we don't have to come to you with a non-renewal or a 15% increase. I mean, that's one of the benefits of pooling. So we've seen consistent rate increases of 7.5% in 19 is what we're seeing for the market. And frankly, that's probably pretty close to what we'll pay for our reinsurance. That's sort of what we're calculating in. Obviously, loss challenge placements are much harder to place. So if you have poor construction and you're on the coast, particularly if you've had a couple of hurricane claims, it makes it even more challenging for us. There is capacity out there. So, I mean, the good news is we can get it. A lot of you folks I've known for a long time, and you guys around back in 04, 05, 06, you'd have a $50 million building and you'd have it insured for $5 million because that's all you could afford or all you could get. That's not the case. I mean, we can get the appropriate limits. It's just expensive. The 2020 property rates may experience similar trends. At this point, with the activity that we've seen worldwide, I wouldn't expect anything different in 2020. Again, we'll look to mitigate it as much as we can. And then one of the first thing insurers do, rather than mess with rate, is come back and increase deductibles, restrict coverages. That's one of the things that we've really prided ourselves on. And we've had a very good property coverage for a very long time. And every year we have to fight for it. And this is really the first time all the years up till maybe last year, I got up here and I talked about some hypothetical losses. Well, what would happen if, and here's where we're better, well, we got hit with a couple of major hurricanes. We've got some real world examples now where it's just not hypothetical. Auto liability. I think everybody knows distracted driving is a huge issue. My daughter still claims that she dropped a hair beret, and that's why she rear-ended a car. I think she was texting. All the new vehicles, I mean, they're all really cool. Every vehicle now has backup cameras and road sensors and all that, but all that really did, it's cool technology, and I've got them in my car, but what that does is it takes a fender bender that 10 years ago was like $1,500. It makes it $15,000 because they got to replace all these sensors. So the auto phys dam is deteriorated, the auto liability. This story will never change. The areas of Florida vary a little bit, with South Florida being the worst as far as the experience. That's also where the majority of the attorneys are. And by the way, for anybody that doesn't know, our office is right downtown Orlando, and we're in the Morgan & Morgan building. And I think there's only 3 things in the building. I mean, there's like News Channel 13, Morgan & Morgan, and us. I tried to cut a deal with them, it didn't work. So on the auto, and again, this is the general market. I don't want anybody here to walk out and think that this is what we're proposing, but nationwide, the auto market's going up about 20%. Now, we do have some organizations we're going to have to work with closely, as we always do, because the highest rate increases are if you have any group transportation, and we've got a whole bunch of community transportation coordinators that may be here represented or not. Those are going to be more challenging. Those of us in the DD community that have 15 and 18 passenger vans, those have always been a problem. They're going to be an extra problem this year. And the whole industry. It's amazing. You see all these advertisements for all these auto carriers, you know, a lot of the personal line ones. At this point, none of them are making money, but they sure spend a lot of money on advertising. Let's talk about GL and PL. The general liability, professional liability market has been very soft for about the last 10 years, so it's been very stable. All of a sudden, and we're working real hard to try and understand why, but not just our experience over the past 24 months has spiked, the whole industry's experience has spiked. So, of course, that's going to drive pricing for GL higher. Florida is now third in population. We probably are second in number of attorneys, so it's a very litigious area, particularly some pockets of it. We know where those areas are. Abuse and molestation coverage has always been a problem. When you're in a soft market, the carriers tend to kind of take a more laissez-faire attitude towards it. That's something we're going to have to work real hard to keep our coverages on. And the increases, again, have been kind of in line with the other lines, which is 10 to 15%. We are one of the 10 most litigious states. Like I said, I think we're in the top 3. And social service agencies in Florida. I mean, we're looking at, and again, this is pretty much what we're expecting to pay for our reinsurance increases. This is not, we should be able to mitigate these things. That's part of pooling. So this is not indicative of what you're going to see, but I mean, we're expecting to pay this. All right, work comp. Work comp in Florida, I was talking with the insurance commissioner, David Altmaier. He's deciding right now, in fact, it's on his desk, OIR, the Office of Insurance Regulation, has proposed, I think it's a 5.4% rate decrease, which sounds like it would be a good thing, with the exception of, in a lot of our classes here, the rates aren't adequate. And that's one of the things that FIT brings to the table. FIT is one of only a handful of pools that has the ability to deviate off of NCCI rates. So if the rates go down too far, what ends up happening is we just lose choice. Because as you guys know, our goal is to bring you guys the most competitive package. And I can look around and I can see several clients here where there have been times when we came to them and said, here's a FIT quote, but here's another carrier that's willing to do it for less than we're willing to do it for. And there's been several clients. They're still long-term clients. I mean, that's the way we do business. We want to be the best option every year. But what happens is we lose those options because the carriers simply say, we're not going to do it. And I mean, Peter could name the class codes off the top of his head that are problematic. I personally don't know them anymore. Overall, though, due to payroll growth, the premium is still going up. So I think most of our organizations are getting fairly healthy. It varies by type of entity. The other thing that a lot of people don't take into account is the way your experience mod is calculated. It's essentially, to simplify it, it's the rate you pay versus your losses. Well, if the rates go down, the experience mods tend to go up. And I mean, I always tell people, you pay with dollars, nobody pays with rate. So don't focus on the rate, focus on the dollars that you're being asked to pay. This is a slide. It's a little bit tough for me to plan for this presentation because, as Joe said, we've got a bunch of people here that this is the 13th one. There's also a bunch of people here that it's the first one. But this is one I usually start with, and it's just to make sure people understand that insurance pooling, although the law that allowed this pool to exist was passed in 2007, insurance pooling was the only insurance around for roughly 5,000 years. I mean, it started back with the ancient Babylonians, and it was just the same thing FIT does. It's spreading of risk. Now, they didn't fancy have policies and all that stuff. They simply decided, look, if I own a ship and my ship goes down, I've lost everything. If I team up with 9 other people and we split our cargo, if the ship goes down, you lose 1/10 of it. So, I mean, it was just that simple, but that was the whole concept of pooling and spreading of risk that goes all the way through. Everybody's heard of Lloyd's of London. That started in the 1600s, and that was the first formal insurance. But what people don't realize was Lloyd's of London was an insurance pool. And the first commercial insurance companies really came around in the 1800s. My favorite historical character, Ben Franklin, started the first fire company in the United States in Philadelphia. He also started the first insurance company, and here's his great idea. I've got these fire trucks, and this is the first time the word premium. So if you pay me a premium, I'm going to give you a sign, and you're going to put it up in front of your building. And if your building starts to burn down, I'm going to bring my fire trucks and put your building out. If you don't have one of these fire marks, you're on your own. And actually where the idea for pooling for nonprofit entities began was in the 1960s. Governments gave themselves the ability to pool. Upwards of 90+% of all governments in this country insure themselves with a pool. And what ended up happening was social service agencies, all the stuff that we do as a group, used to be part of some form of government, and they started pushing them out. So they pushed out the stuff they don't want, but they didn't give them the benefits of stuff like sovereign immunity, which all these governments give themselves, or the ability to pool. So we've done this in multiple states, which is go to the state and say, look, we're now serving the disadvantaged, the homeless. We're serving all these critical groups, and you're taking away from us one of the basic things that we can do. Doesn't cost anybody any money to pass this law. I mean, all it does is it's saving public money. It's just good public policy. Who can pool for insurance in Florida? We got very specific statutes. It all started with governments, public utilities, kind of common sense, housing authorities, independent educationals, institutions, electric cooperatives, and nonprofits. So there's 6 classes. I think the nonprofit was the most recent one, which was back in 2007. But if you look at it, it has a common theme. It's quasi-governmental stuff. Okay, a few things that you should know about FIT. I think most everybody in the room knows this. We were formed under a Florida statute that was passed in 2007. We are governed by a board of directors who thankfully has been very stable and consistent. They're also very personable, so if you don't know them, take a chance to meet them over the next day or two. We have to submit financials and actuarial letters to the OIR. It's due December 1st. We usually turn it in a little early, but anybody wants to have any questions, they can call us or you can just call the state. We do have in the statute, we're required to purchase excess insurance from authorized carriers. So not only are we an authorized carrier, the people that we buy insurance from have to be authorized carriers that are overseen by the state. And the majority of the risk, specifically the catastrophic risk, is transferred to A-rated insurance carriers. This is actually going to be one of my more fun slides to put up, because I've always put up hypotheticals, because our competition for years kept saying that. They don't have enough money. What's going to happen when the big storm comes? Well, we've had 4 big storms, and I think we've got a pretty good story to tell.
There were several of us that had thought about creating an insurance trust for several years, tried to get it done, weren't able to, but then we met Shane Caldwell. And Shane showed us how to create the insurance trust. There were 3 of us that were the original members, and we created the trust, and it's been 11 years of fantastic results. You know, insurance is one of the most expensive items in our budgets. Nonprofits struggle to be able to provide the services that are needed by our communities, and every dollar counts.
On behalf of the trust, we've been able to make sure, give some exposure to the nonprofits in the trust, work to help expand the trust and give additional options to the trust, that for all these nonprofits, to give them the competitiveness they need in the insurance market. The more we've represented the trust, the more we've understood that insurance costs aren't going down, whether it's property and casualty or health. The legislature can and should do more, and they usually do. And many years, the last 10 years, we've been proudly going up to Tallahassee and working on behalf to make sure that these nonprofits get the funding they need, first and foremost, but two, protect this entity and expand the options for it so that they have better options in their insurance.
The flexibility that Fit has versus separation of other carriers with dual types of insurance claims, whether it be through D&O, EPLI, or if it's auto versus workers' comp. I saw the benefit and the value in having that one-stop shop.
I'm blessed to be a part of the trust, have been since 2012. And I think one of the things I like best is it is a perfect demonstration of the power of pooling. To me, it's a brilliant concept. If you think about taking the power of the membership and putting it behind the program, through the leverage of membership, you have the ability to not only squeeze down pricing, but the ability to expand coverages.
Yeah, we've been a customer of the Fit for the last 6 years or so. We really appreciate the fact that we have all our coverages under one umbrella. It makes our budgeting process a lot easier. It allows us to really have one line of communication as far as where the claims go. You don't have to worry about multiple agencies, if you will, and so it's worked out real well for us.
Our experience has been outstanding with the trust ever since we signed on. Property insurance has just went skyrocket high in Florida, and obviously that's a big ticket item for any nonprofit budget, and so anytime we can cut those costs and still get great service and great coverage, it's a boon not only to us as a business, but certainly then to the people we serve, because it means there's more money left over to provide services.
This conference is excellent for networking and learning things that have worked for our peer organizations and benefited us tremendously. In general, the members are peers, fellow not-for-profits, and always learning, and it's great to be a part of FIT.
Our experiences have always been positive. As far as the conference goes, I always go back to the office with new information, which is really helpful, and it covers a variety of subjects, which is beneficial to us, I think, as an organization.
I love the engagement in meeting with other nonprofits, other agencies, Goodwills such as ours. It's great to network with those folks and share experiences and exposures with them that we're experiencing in our agency.
Well, we've been doing the conference now for 10 years. It was a fantastic thing to start. It's for the benefit of all the members, and it's just great to have 170 of your folks here that are fellow FIT members, and the camaraderie and the educational aspects are good for everybody.
If you'll note, we've got some audio-visual people around. We'll probably be asking a few of you guys to give testimonials if you feel good about what we've done. I believe very strongly we've got some really good feel-good stories. If our folks approach you, no commitment, but we'd really appreciate it if we did a good job. Tell us in a testimonial. If we did a bad job, come see myself or Hasib or Peter or anybody that's on staff. I opened up with the different service providers. We're kind of the face of it, being NPIS. We organize this. We're the ones that go out and do the loss control and the claims reviews and all that stuff. But there is a whole big team behind the scene that runs this thing. Independent accounting, Shores Tagman Butler is absolutely the best in the industry. NPIS is us. Of course, we have our agent partners, and I think everybody here knows we only deal with agent partners that have substantial experience in this. We want them to bring something to the equation. The independent actuarial, we deal with casualty actuary consultants, and again, almost everything that all these people do is part of our filing to the state, which is due on December 1st. Legal, we use Jack Brennan's law office up in Tallahassee, does a great job. And of course, York Risk Services, we've got that dedicated team that works down in that Boca Raton office for us that has done a good job for us. They've been with us. We've changed none of these things since we started it. We think we started with the best of breed. And as long as everybody's doing their job, we're gonna be consistent. A question that we get, and this is for the newer folks, how can we charge less premium and still stay solvent? And the answer is real simple. It's like 3 or 4 basic things. The number one is insurance companies are not efficient. So if you just look at every incremental part of the insurance purchasing process, administration, an average insurance company has about 16%. That's issuing policies, underwriting, all your day-to-day stuff. Well, we do it for something less than 10. Commission, a typical commission for a policy for an agent from a standard carrier would be 10. Well, we pay them 6. That's why we deal with specialists, because we're dealing on volume. Same thing on the P&C commissions. It's typically 15 from an insurance company. We do 10. So we even have a tax break in the state. Our premium tax that we pay is 1.6%. Depending on the line, an insurance company will be between 3 and 6%. So, I mean, if you start adding all that stuff up, you're talking about a very substantial dollar, and it's simply just doing it more efficiently. That's not doing it any smarter. That's just being more efficient. And then on the claims handling, we've had a lot of good feedback, but I think everybody here knows we really, really focus on closing out claims. The longer a claim stays open, the bigger it tends to get. We talk about it at every board meeting, and we track this in a matrix, and we close out claims about 30% faster than standard insurance companies. And by doing that, we don't have a bunch of legacy claims. Legacy claims can really wear you down and really cost a lot of money. So when you talk about the fixed costs and you talk about the claims handling, yeah, we've got about a 20-some-odd% competitive advantage, where we should be able to be consistently somewhere in that neighborhood better than the standard market. All right, let's talk about our financial summary. I know this little slide over here, it's got a lot of detail, but you guys probably can't see it. But essentially, the important lines, member contributions, that's technically what we call premiums. So we were at 40 million last year, we grew to 44 million. Carrier expenses, this is us buying insurance. So we buy about $13.1 million worth of insurance to protect against catastrophic losses. The loss and loss-related expense, at this point, we're paying about $19 million a year in losses on behalf of our members. And the important part about this $19 million, it's the $19 million that comes out of our funds. All of these excess carriers, so when we talk about what happened with the hurricanes, the numbers are far in excess of that. This is just the stuff that comes out of the money we're handling. Total underwriting expenses, this includes commission, TPA expenses, administrative expenses, all of those things total 11.6. Still, on this much money, the investment income is woefully low. I'm not sure if everybody knows, but over the history of insurance companies have not made any money underwriting. They make their money off investment income, and it's really, really, really tough. Particularly, we're governed a little bit different than insurance companies are. Insurance companies, in general, depending on the state, you could at least some of it in equities. We're pretty much cash and cash equivalents. When we say cash equivalents, we're talking about U.S. Treasuries. So, I mean, on having as much money as we have sitting aside when we get to the balance sheet, to only earn $301,000, but hopefully that'll start coming back. So the bottom line, and again, these numbers, these audited numbers will be to the state here in the next 30, 45 days, was $519,000. Now, what that represents is the pool has a stated goal of wanting to grow surplus every year, somewhere between $50,000 and $250,000. We had a pretty good year this year, and we ended up at 500. We do need that. We need some surplus, because when we go to the balance sheet, that's not the money to pay claims. That's money over and above what we need to pay claims. We need to make sure we're setting aside the proper amount, and when we get to the balance sheet, that's there. What that number represents is, on any given year, how much more we charged you than we really needed to charge you. So, balance sheet, it's pretty clean. I mean, we don't have much in the way of assets or liabilities. You can see our cash and cash equivalents is sitting at right at $20 million. And again, we leave a certain amount in cash for payment of claims. The rest of that stuff is primarily U.S. Treasuries. Total assets total $33 million. And from a liability standpoint, essentially we have loss expenses, which are $30 million. which gives us a fund balance, which in insurance company talk, that's surplus. So over and above the cash that we've set out, that $20 million, so the $20 million is sit there to pay for claims under what we retain. All the bigger claims go to the insurance companies that we'll talk about here in a second. So we currently have $1.7 million over the amount that the actuaries tell us we need to pay claims in our layer. You can see we've been fairly consistent. It's been represented at this meeting. To put some numbers behind it, I just happen to know these, but the first year we had the 3 originating members, but we ended the first year, I'm almost positive, with 17 members. It's 13 years later, and I don't know the exact number at this point, but it's certainly north of 50. So, I mean, this line just shows you, I mean, we've grown pretty linearly. I mean, it's not like there's a bell curve, we hadn't taken off, but we just, you know, every year when we come back and we do the same thing. So probably the first time we approached all of you and we were pitching something new via our agents, we typically, this is not a 1-year sales cycle. This is a 2 or a 3. We need to get people out here to understand, and word of mouth is by far our best marketing tool. So please, if you like what we're doing, please tell your friends. And then here's our written premium. Again, it's pretty well right in line with the number of members. So the average size of the member is averaged the same over the years. Our total range, I mean, a small member for us is probably $25,000, $30,000 in premium. A big member is about $1.5 million, and we've got a spread all in between. But so far to date, we've processed $150 million of claims. And something we're very proud of, and this is what it's nice to finally be able to talk in non-conceptuals. We've had 4 major hurricanes over the last 3 years, and we just shared you with the balance sheet. It had no impact on our balance sheet because the trust doesn't retain any risk. So I'm going to show you the big numbers that our insurance carrier partners paid, or we adjudicated on their behalf, but it did not affect our balance sheet a dollar. Our carrier partners, these are the guys that really help us make it happen. A couple of them are in the audience today, and we really appreciate them coming. Markel supports us on the excess liability. They have done that for several years. Lloyd's of London is our primary property. We'll go through what our property structure is. We have enough cat exposed property that we have to involve a whole bunch of carriers, but Lloyd's is the lead on it. And then RSUI, they do the D&O and EPLI. So there's all this parts moving behind the scenes. All that you see is when you get a claim, you turn it into York, who adjudicates it on our behalf. But behind the scenes, it's getting split up to a bunch of very, very large organizations. Okay, the property program. This is something that's going to be interesting this year. The first thing insurance carriers do, if they're having bad experience, they try and do 2 things at once. They want to raise price and they want to decrease terms. We've worked really hard over the last 10 years to get it. These are the color-coded are the wind deductibles. We're the only carrier that I'm aware of that we only have a 5% wind deductible in the Tri-County area. The rest of the coast is at 3 and inland is at 2. And almost everybody here over the past 3 years has had a hurricane claim, and it doesn't sound like there's a big difference between 2 or 3 and 5. Do the math and see how much money you get. It's very, very substantial. So we're going to be working real hard to hold the line, but this is going to be tough. This is the first thing they're going to push on. Here are some of the coverages that we've been giving you, philosophical, hey, what would happen if? Well, these are the real impacts. We still have the lower deductibles. We have $25 million in business interruption. We paid more in business interruption claims than we did physical damage claims to the buildings. That's where a lot of it comes from. We build it in for everybody. As a matter of fact, another one that came in really big is we have a $10 million in miscellaneous unnamed locations. There is an account, at least one, I'm not sure how many, but there's at least one that forgot to schedule a really big building, and the big building disappeared, and that loss got paid. And I know that's one of the accounts I'm going to ask to do a testimonial, because it's different hearing it from somebody than hearing it from me, but we paid for a building that wasn't on the schedule. $25 million ordinance or law. We got so many people that have habitational exposures here, and the schedules tend to be old. So that coverage, you know, until you have a loss, you don't realize how big that can be. We had several building ordinance or law coverages that came into play during these hurricanes. 25 million in flood. I think that speaks for itself. This is in excess of NFIP. Prior to membership in the pool, I think most folks here just relied on NFIP. They didn't have any excess. We give it to everybody. The $50,000 of evacuation expense, we had a lot of people that took advantage of that. We had a lot of people that had to evacuate folks. It can be very expensive. And of course, we have active shooter and terrorism coverage included in our property form. So I mean, this is really, I'm not going to put anybody on the spot by asking for on-the-spot testimonials, but I really want you to talk amongst yourself, because this is not theoretical. These are real dollars getting spent at this point. What happened to us in the major hurricanes? Irma wasn't that bad for us. Irma was about $3 million. The way it came up the state, we just flat out got lucky. It could have been very big. Michael cost us a little over $20 million, and that is a live picture of a fit member. So we've got a lot of business up in the Panhandle, and obviously it got hit pretty hard. But we paid $21 million, and we keep track with the state. You know, one of the things that we promise is not only are we going to adjudicate claims fairly, we're going to do it fast. Within 30 days of the hurricane hitting, I don't know the exact number, but we had fronted huge amounts of money. We hadn't got it from our carriers, but we got that $20 million sitting there so people can get back to work. And as far as we are out right now, we've had well over 2/3 of the total losses already paid for, which is probably 50% better than the industry. So a full 50% better. You're paying us a lot of money to insure you. You have a reasonable expectation if a building blows away, we're going to pay you the money to rebuild that building. And insurance companies are notorious at slow paying, because again, that's where they make their money, on investment income. So they want you to pay your premium really fast, and then when you have a loss, they just want to kind of slowly trickle it out. We don't play that game. We're going to get you the money. We're going to rebuild the building. Okay, we often get the question, okay, we have 250 plus members. How do you know how much hurricane insurance to buy? It's a great question. There's a couple of really big companies that came up with these big fancy models that are the industry standard. One's called AIR and one's called RMS. We run our schedule, which means we take every single location for everybody. This is a very voluminous report, and we run it through all of these algorithms. And what they do is they give you a probability of how much that's going to be. So it's pretty simple. So the 5-year average loss, that means you have a 20% chance of having a loss that big in any given year. So the report shows us that for the 100-year loss, which is a 1% chance, doesn't mean you can't have back to back to back. It's just saying on average, you have a 1% chance of having losses that pierce that. That number's 33. The 250-year event, which means you have a 0.4% chance of having that hurricane hit, that number's 51 million. The 500-year, that's a 0.2%. So you're getting pretty far up there at 68 million. And the 1 in 1,000 year event, which it actually even goes higher than this, is a 0.1% chance. So the golden standards in Florida are two things. Everybody's heard of the state-backed insurer, Citizens Property Casualty Corp. Citizens buys to the 100-year event. The gold standard to be an A-rated admitted insurance company in Florida is the 250-year event. So if we were doing what the state requires of Citizens, we'd be buying $33 million worth of property coverage. If we wanted to be the gold standard for insurance companies, we'd be buying $51 million. We buy $150 million. And we do it for two reasons. The industry believes in these charts so much that once you get so high, it gets somewhat cheap. The other part is the whole industry runs on these, but I personally and a lot of my team, I don't think it's right. So, I mean, we're going to be overly conservative. I'm not sure how off it could be, but I certainly don't think it's 3 times. We buy 3 times the gold standard limit. Other large losses if you exclude hurricanes. So, I mean, the hurricanes, you saw the big number, 20 some odd $20 million, but these are, and this is what's starting to drive the general liability and the auto, $2.4 million, $1.7 million, 1.2, 1.1. I didn't want to bore everybody with little descriptions, but this is pretty much an equal sampling of auto losses and general liability losses. So, I mean, and if you'll look at it, these are all recency. Well, there's a 15 there. Most of these are 17, 18, and 19. A few things that we're proud of that we've accomplished over the past year. We did successfully handle claims for 4 major hurricanes. I don't know, I think everybody knows Jennifer at this point, but Jennifer and her staff, we've improved and expanded the claims management and loss control services, and on a go-forward basis, that's going to continue to be a bigger and bigger issue. We're going to continue to staff that department. We've given back, as I had mentioned earlier, $200,000 plus for the benefit of the membership, and something that we're very, very proud of, in 13 years, 250 current members. It's kind of proportionate going back, but if you add that up, that's thousands of member years. We've never non-renewed somebody due to claims history. We've had some sit-downs with people and talked about what we could do, but we haven't non-renewed anybody. That's part of the shtick of being in this thing. You're not going to get surprised. You're not going to get non-renewed. That's why you buy insurance. It's always amazed me how insurance companies, you pay the premium. I do it on my personal lines. We never have any losses. You have a loss and they dump you. That's what you buy insurance for, folks. I mean, I don't know why else you guys would spend money if people were going to dump you the first time they have to pay out. The acronym, when you're in the pool business, no matter what your name is, they're going to call you an acronym. Florida Insurance Trust, at least it's kind of cool. We've got some that are just horrific. If anybody's got any questions, I'd be happy to answer them. With that, Peter, thank you very much, everybody.